Okay, hello everyone, and welcome to another training video. And in today's video, we are going to be discussing a very important aspect in trading, which is confirmation. So we're going to be talking about trade confirmation or entry confirmation, and what you should know, and some of the best practices and how you can apply that to your trading. Now, this concept in itself, it's one of the very essential weapons basically in your trading arsenal that would enable you to become a good trader, to move from being average to being good, or to move from being good to being great, right? Trade confirmation is very important and also very essential when it comes to trading. Now, we're going to look at a number of things, just very brief slide before we go over to the chat and look at examples of break down exactly what we're trying to say here. We're going to run through, what are the essential things that should be included in your trading plans, and then we'll look at the different types of confirmation that you could use dependent on what is comfortable by you. Now, if there's anything you should know about me at this point is I don't tell you exactly what to do, right? I don't tell you, oh, this is the best way or that is the best way to do certain things, because what I figured out over the years of my trading is there are different types of traders and different people are comfortable with different things. But one thing that I can say that is constant about amongst traders who are consistent or who are profitably more than the others are those who have a system and follow it. I've seen people who trade simple trading system, just as moving average, crossover, and maybe another indicator, but they have a system in terms of they have a plan, a trading plan, trading rules that they follow, and then they are profitable. And then I see other people who maybe trade with robots, or other people who trade smart money concepts, or who trade price action. You can be profitable as a trader irrespective of the style of trader you are. But you would never be profitable as a trader if you don't have a trading plan and if you don't stick by it, because what would happen is, even if you've learned a lot over the years, you understand, you learn smart money, you learn this, you learn every single thing, but you don't have a trading plan. A trading plan is a rule-based trading system. It's all about rule-based trading system. Okay, this is what I look for to get into trade. This is how I get into trade. This is how I manage my positions. Understanding that you'll be wrong a lot of the times, then you would never be able to be a consistently good trader. Okay, so we'll look at basically what should be included in your trading plan. I don't care what type of trader you are, you can apply this in your own style. And then we'll look at the different confirmation types when it comes to trading. So please stay tuned. It's going to be quite interesting as we cover this course together. Now, what's your trading plan should include? A good trading plan should comprises of a number of key points. Now, the first point there should be how you classify a good opportunity to buy or sell. Now, what does that mean? It means, how do you determine whether you want to place a buy or a sell? Now, for many people as traders, they open the chart and they see the market's going up, and they try to buy, or they see the market's coming down, and they try to sell. They don't really plan their trades. The first point is very important. You want to identify how you classify good opportunities to buy or sell. Now, what does this mean in practical terms? Imagine if you are an indicator type trader, right? So you look to trade overbought and oversold, maybe using the RSI and the stochastic, for instance. Now, with that particular rule, let's say your trading system is this. If price is overbought and let's say if price is overbought and RSI is above 70, then you're interested in selling. You understand the concept? Or if price is oversold and RSI is below 30 or 20, you're interested in buying. Now, those two things are how you classify opportunities to buy or sell. Do you understand? Those are how you classify opportunities to buy or sell. Now, just because price is overbought and RSI is where it is, does that mean you buy or sell? You've done the first part, classifying your opportunity. Now, if you have a trading plan and you should look at it. It should be like a notebook, right, that contains your trading rules. It doesn't have to be long or anything. It just needs to be detailed. This is what I look for. This is what I look for, until it becomes second nature, where you go to the market and you only look for opportunities you are interested in. Now, once you've identified that, the second point is you want to you need to, the area or zones you are interested in looking for opportunities to go long or short. Now, what that means also is after you've identified why you should be looking to buy or sell. So for instance, if you're a trend trader, you're looking to buy or sell in the direction of the trend. Well, just because the market is bullish doesn't mean every place is a good place to buy. Right? Once you've identified that, okay, this is what I'm looking to do in the market, I'm looking to buy, or I'm looking to sell, the next point will be, okay, so where am I looking to buy or sell? Right? If I'm looking to buy or I'm looking to sell, where are the areas I'm looking to, either do this buy or sell? So for instance, imagine that you're a trend trader, you trade in the direction of the trend and the market is bullish, for instance, right? So market is making higher highs and higher lows. Okay, where's my mouse? Price is making higher highs and higher lows and higher highs, and your system involves trading in the direction of the trend. Let's say you trade Fibonacci, for instance, right? So based on your system, if you see the market make a new high, and then it's pulling back down, right? The price is pulling back down, you draw your Fibonacci from low to high, and let's assume that based on your system, you only trade 61.8 to 78.6, right? So your system says you're looking for a retracement into 61.8 to 78.6. Now, the thing is this, right? Because the market, you've identified that you're looking for buying opportunity, the first point, right? You've identified that you're looking for buying opportunity because the market is bullish. So that's how you classify a good opportunity to buy. The second point is, okay, so after you've classified that the market is bullish and you're looking for buying opportunity, which areas or area are you interested in looking for opportunity to buy, which is the second point. Now, based on, let's say you're a Fibonacci trader, you're looking to trade 618 or 786. So let's assume that this portion here is the 618, let's say down here is the 786. So this area, this region here is the zone you're interested in looking for buys. That means even though you're looking for buy opportunity, you want to see price drop into the zone. And then if price, let's say, drops into that zone, you are now, interested in looking to buy. Now, once you've done that, you've identified the area interested in looking to buy or you're looking to sell. The next point, another key area of your trading plan should be, how do I manage risk and reward, right? So for instance, all of these things, this is not exactly the order, right? But these are key points to have in your plan. Now, you will now say, okay, well, I don't want to risk more than 1% of my account on any trade. Let's say that's your rule. And price has gotten into an area you're interested in. You say, okay, if I'm wrong, based on your system, where does my stop loss stay? Now, let's just assume that for this instance, if we are looking to buy, our stop loss will be down here, right? Let's say down here, and our targets would be this high, right? So if price comes down here and we buy, we're risking this much, and our target is this much. Now, I have a separate video on risk management and trade planning and all. This is not about that, but how you manage your risk to reward is also something that should be included in your trading plan. And then we come to so we've answered the third point, and then we come to the fourth point: how do you confirm your entry? Now, just because the markets, you've classified a good opportunity to buy or a good opportunity to sell, you've identified the area you're interested in buying or selling from, and you determine how much you want to risk per trade, doesn't mean that once price gets there, you should place a trade. Now, many people in this kind of case will do something like this, right? Where they would, okay, let me see if I can clean some of this. Let's take out some of this. And okay, so now many people, when they identify, let's say they identify this area as an area to buy from, will do something like this. They will maybe set a pending order here, or maybe another pending order here, right? So they might set pending orders and then put their stop loss and targets. Many other people will not even use stop loss. And what will happen is, well, if price comes back down, they're hoping that price would now go their way. Now, this system is not bad. It's not terrible. It's not a bad idea, right? But how many times have you have an area you're interested in? Everything looks okay. Everything is so perfect. You're looking to buy, and then price just comes. Price just goes down and flushes down. You know, it doesn't respect anything. It just blows past it. Let's say you're looking at a level of, let's say you're looking to trade double top or double bottom or some sort of reason. You're looking for price to hold at a level of resistance. For instance, you want to sell, and price just comes up and blows past it. Now, if you don't use confirmation, let's say you just place pending order, you find yourself either taking a loss, most likely, for those of you who use stop loss, and those of you who are naive enough not to use stop loss, will just be sitting on your account wondering why your levels don't hold. And this is where confirmation comes into the play, right? So trade confirmation, how you confirm your entry, is one very important aspect of trading that could enable you to basically enhance your trading potential profits, right? So how does that work in this case? How do you confirm? You know, all of this, each of these four areas are essential areas. But this fourth one, in terms of confirming your entry, would help you avoid trade situations where there is no reason to trade, right? Situations where the market does not give you a reason to trade because maybe the market has decided it doesn't want to go up anymore. It's now ready to come down. And if you just be patient enough to confirm your entry, you would not get into this wrong trade. Now, there's also the disadvantage of waiting to confirm your entry. Situations where, let's say, you're waiting to confirm price at your entry level because price is bullish, and then the market comes down, you don't get the entry and it just pushes away from there without having you involved. And those kind of things can be painful, I understand. But the truth is, in the long term, looking to confirm your entries will save you more and give you a better, make you a better trade and give you better peace of mind in trading than just jumping into trades because you're so scared of missing out on opportunities. You know, fear of missing out is what causes people to jump into trade prematurely, jump into trade without confirmation, jump into trade with poor risk management. So you want to, there's the flip side of it. There's also the other side of it, but you want to look to confirm your entry. And there are multiple ways you can look to do that. You don't have to use all of them. It's all entirely up to you, and it's all down to your system. It's all based on your system, based on what you're comfortable with trading. Okay, so what are the different types of confirmation? Now, depending on your preference, there are different methods that you can use or that are used by traders to confirm their entries. Now, it will range from price action. So price action confirmation, if you see those people who, let's assume you're a price, you look for price action confirmation. Now, price is going up, you're looking to buy at the level, and let's say you're looking at this previous level of broken support, broken resistance to turn potential support. You want to buy from here, right? Now, you also don't want to just buy. With confirmation, you want to see reasons to buy from here, not just buy. So what you do, or what you'll be looking to do, is, okay, how do I confirm that price? And guess here's also another important point. Just because you confirm the entry doesn't mean that price must go your way. Just because you find confirmation doesn't mean that price will definitely go your way. Sometimes you would see the confirmation you're looking for, and then price will eventually blow past it. It is okay. What I've been teaching you for a long time, and for those of you who join my classes, is that you don't be emotionally attached to your wins or your losses. If you make profits, it's fine. If you make profit or you make loss, I should not be able to tell by looking at your face, right? You know, there are several people, if they have a good trading day, you would know. Their countenance will be so lively, they'll be jumping, they'll be smiling, they will tell you. When they've lost, you would know because they'll be so down, they'll not even be able to drink water. You know, if they have a bad trading day or they have a good trading day, well, if they make a good trade or a bad trade, you would know from their emotions. Now, you don't want to be emotionally attached to profit or loss or to wins, right? You don't want to be emotionally attached to wins or losses. You want to be like a robot, unemotional, taking decisive action over and over again without flinching. Okay, so now back to the point I was trying to make. Now, let's say you're looking to, okay, price has broken previous resistance, you're looking to buy from support. A price action trader would be looking at, okay, if price comes back down here, I want to see bullish confirmation in the form of bullish price action candlestick. So let's say you want to see like a bullish pin bar, right? So let's say a bullish pin bar from here, or a bullish engulfing bar, and that will serve as confirmation. Now, if you see that, that is your confirmation That's the kind of confirmation. You're looking for bullish candlestick formations to look to buy and then take price to the new highs. So you see that you've planned your trades, you've identified the area you're interested in buying from, and then you're looking to buy based on price action. So price action confirmation style is where you look for confirmation in form of price action candlestick setup. Now, the next form of confirmation that traders also tend to use is indicators. Now, indicator is also another popular one you find within the trading community, where you find traders look to confirm their entries with indicators. Now, there are several indicators and several use cases. Now, remember, if you decide to use any of this, you want to do proper testing and back testing. Don't just take anybody's word for it and say, oh, this always works. You want to back test it, you want to forward test it, and then once you're confident enough, you want to add it as part of your trading plan. Okay. Now, so let's say an indicator type trader, same scenario, same price break above a key level, the market is bullish, so he's looking for buying opportunity, and price is pulling back, is interested in buying from this area. An indicator-based trader might look and say, okay, I want to use maybe the RSI. So you know what the RSI or the stochastic, and say, oh, you can use a number of confirmation systems, right? You don't want to complicate matters. Now, somebody can say, well, if price is pulling back, I want to see that price is oversold, right? I want to see that price is oversold. Let's say I want to say that the RSI is within oversold level, and then that will serve as confirmation. If you see that, the person can now say, okay, this is my confirmation, right, to get involved buying and to take price up here. So you notice different approach, the same basic idea, right? I'm not going to tell you which one is better or which one is worse. You have to figure out and identify that by yourself, by testing and back testing and figuring out what is most comfortable for you. And if you're looking, we have classes. I have several trainings or classes on price actions, on structural shift, on trend line and counter trend line breaks, all of those fancy things. Your own is to learn, practice, and see if it's something that fits your own system. Now, so that's what an indicator-based trader will be looking out for. Now, I just used the example of RSI or stochastics. There are lots of indicators, and you can use a combination of multiple of them. It's entirely up to you. Somebody else might still use moving average as an indicator and say, okay, if price, okay, let me just clean out some of this. Let's clean this. Okay, so somebody else, a different person might still using indicator, might decide to use a different indicator and say, okay, well, I'm going to use a moving average, right? I'm going to use a moving average on a smaller time frame, right? So maybe use a moving average on a smaller time frame, that if price maybe breaks above the moving average on the smaller time frame, like so, that would be his own confirmation to start buying. So you can see, but you get the whole idea is, in this case, the person is using moving average, or using moving average to confirm their entry. The other person was using stochastic, another person is using RSI, some other person is using MACD, some other person could be using Henry candlestick, or a combination of multiple things. But the idea is, you've seen price get to the region you're interested in, you want to watch for confirmation before getting involved in the trade. Now, the other style of confirmation that you would find that some traders use is also the counter trend line break. Now, counter trend line break is some sort of a system where, yes, the market is, so for instance, in this particular instance, in this particular scenario here, price is bullish, so we're looking for buying opportunity. Now, let's assume that this chart, right, is a daily chart. Let's assume it's a daily chart. Now, this movement here on a smaller time frame, let's say the 1 hour chart or the 2 hour chart or the 4 hour chart, would have its own structure, right? So it could look something like this. Now, counter trend line break or confirmation would be something where you look for the trend on that smaller time frame and watch for the markets to break it. So in this case, if price breaks above this area, it could serve as confirmation to look to get involved buying, and then to take price to the higher time frame targets, right? So you see, this is how you use the counter trend line break setup or system in looking to confirm entries. I think I have a video also on counter trend line breaks. If I don't have, I'm going to also make one. So you can, each of these individual points you can apply specifically after you've decided on what you want to, or which exactly you want to focus on. Now, what you don't want to do is decide to start looking for every single thing at the same time. You want to use price action, you want to use indicator, you want to use counter trend line. You want to use every single thing, or not necessarily. As a matter of fact, if you use every single thing, it's even good. What people will do is they are neither here or there. Today, they are looking for price action confirmation. Tomorrow, they are looking for indicator confirmation. Next tomorrow, they are looking for counter trend line confirmation. Another time, they're looking for structural shift confirmation. You don't want to be all over the place. Pick one, do it well enough, long enough. Try it on at least 100 trade setups, and then record the result and see if it makes sense at the end of the day. And then you can move on to the next one, and then the next one, and then the next one, and you figure out, okay, which of them is better for me, and which of them is most comfortable, and which do I stick by. What you don't want to do is today you're looking for price action, and you're trying to use that to trade. Tomorrow you're trying to use indicator. Next tomorrow you're trading Y curve or something else. This is something entirely something you don't want to do, because this would have a counter effect to your trading. And then the next point is structural shift, right? Now, this is not exactly all the points. I'm sure I missed. I could add a couple here. You could also add smart money confirmation concept in terms of Y curve accumulation or distribution schematics. I have a video on Y curve accumulation and distribution schematic out. You can also watch that as well. And so in terms of structural shift, so a trader might still be looking. So let me still use the same example. Let me clean this, take this out, and take this out. Now, the same example, a trader who is looking to who is basically like looking for structural shift, has identified, oh, if price comes down here, I'm interested in buying because this is previous area that should probably serve as potential supply or demand area. And then what you want to now, what is structural, based on structural shifts, might now go to the lower time frame. Now, this area here on a 1 hour or a 4 hour chart might look like this, right? Bearish, might look bearish, right? Making lower lows and lower highs. A structural shift to be a point where price now begins to make higher lows and higher high, and that could be the confirmation. This is also what you would term Y curve. So something to elaborate more on this would look a little bit like Y curve accumulation schematics, and then that could be your reason for getting involved, buying, and then still targeting this high. So you notice how we applied everything that we just talked about here and put it together into one comprehensive, what I call a comprehensive video, where you can look to apply every single point in different ways depending on what style of trader you are. Okay, so now what we'll do is I'll just go over to the chart. I will look and see if we can find some chart example where we can try to explain using some of this. Probably will not be able to use all, but some of the confirmation styles and what it would look like in live market conditions. Okay, so let's go over to the charts. Now, you can apply this concept on any single instrument, every single time frame. You can do the same thing there. Now, this is Euro USD, the most traded instrument. Let's just, what do you call it? Let's just take this for instance, right? You can see that very clearly within this area here, the market is clearly bearish. This is a daily chart, by the way. Market is bearish, and how do we know it's bearish? Well, you don't need a fortune teller to tell you that, because you can see that price is clearly making what? Lower lows and lower highs and lower lows and lower highs and lower lows and lower highs. So basically, it's a bearish market because of the structure in the market, right? So all within these areas, the market is bearish and so what are we looking for? We're looking for selling opportunity, right? Within the bearish market. Now I'm going to delete those. Now let's say, right? Where do I start from? Let me just speak somewhere. So let's take this for instance, right? So we've identified the trend. We've seen the structure of the market. Price has made a low, made a high, and made a new low. So we're looking at a bearish market because it's making lower lows and lower highs. So what do we expect price to continue to do? Well, to continue to make lower lows and lower highs. Now, if you're imagine, so we've identified what we're looking for. Now, the next point is, what areas am I interested in buying or selling from? Now, if you are would I say support resistant type trader, you look at previous levels. So for instance, something like this, right? You can see previous broken supports, you're expecting it to turn resistant. So you can see that this area here held as support basically, and as price has broken below it here, you're anticipating, oh, well, if price comes back to it, it should hold as a confirmation or as a reason to sell, right? Now, in this instance, if you're a price action trader, this is the area, so let me just draw around that. This area here, remember, it's not an exact, it's just an area. This is the area you're interested in looking for selling opportunities. You're looking for selling opportunities, one, because we've identified the structure of the market. We're looking for opportunities to sell within this area for this particular reason, because, well, price is around the previous structure that we're interested in, right? Now, a price action trader will say, well, I want to see bearish confirmation from here. And if I find a bearish confirmation, I would sell. Now, what would a price action trader be looking out for? Candlestick formations, things like bearish pin bar, bearish engulfing, whatever shooting star, all of those bearish setups. You don't need to look for at plenty, you just need a couple, right? Well, as far as, okay, I think I can do replay here. Let's replay from here. So we see our setup, price has broken lower. We've identified this area and we are waiting. So you can see that the truth is successful trading is all about patience, waiting for the markets to come to you, right? So we wait. Let me reduce just a bit. So now price is now making its way back to our region. And what are we looking for? Well, we're looking for confirmation, right? Now, somebody would say, well, you can see, let me bring this up. Somebody would say, well, you can see a bearish engulfing candle here. And you won't be wrong if you consider that a bearish engulfing candle. And then somebody might decide, okay, that's a reason for me to sell, right? And then maybe I'll sell at the close of that candle, or if price retraces, and then maybe put my stop loss above this range, right? Now, here's one thing you'd also want to be, or you also want to understand, is that be open, be okay with the fact that you might take a trade. So for example, what I mean is, I might be looking to sell within this region here, right? So I might be looking to sell within this highlighted region. And within this region, I would find confirmation like 4 times. Out of the 4 times, 3 of them would end up being losses. So let's say, for instance, let's assume that I consider this a bearish engulfing, and I decide to sell the 50% retracement, for instance, or the close of it. So I'll sell, it will be something like this, where I would look to, where's my sell short position? Let's say I sell the 50% retracement of that. I put my stop loss just above here, and let's say I target this low, right? Or maybe I target 2 to 1 or 3 to 1, depending on how your own system works, right? Now, what happened is I wait and price appears to be going my way, only to go on and hit my stop loss. Now, here's the thing, right? Price ended up going to hit my stop loss. I take a loss, maybe 1% loss, right? But if you look at this market, as the market negated what we were looking out for, or what we were looking out for, price has broken below here. We expect price to come back and retest this area, and we want to find confirmation within this region, right? Now, yes, we took a trade here, it failed, but notice what happened again. The market, let me just delete this, formed another bearish engulfing candle, right? So now, because this is still within the confines, right, or within the what I call it, basically within the scope of what we're looking out for, this bearish engulfing occurred within that area. So maybe somebody else look at this and say, okay, I'm going to look for another trade from here, stop loss above here, take profits maybe down, way down, whatever, 2 to 1 or something like that. Or enter at the open of this candle and also go after 2 to 1, whichever your system is, right? Whichever works for you, right? Now, in this case, maybe you get into a trade. Now, It appears we're not getting into a trade. Now, I'm going to pause now, right? Now, let's, just for the sake of this example, right? Let's say we got into the trade. You can see that the reason we got into the trade, even though we took a loss here, is still valid, because what we were looking for in terms of confirmation, we got it, even though we had to take 1, 2, 3, however many losses there. But because we manage our risk, it's okay to take losses, right? Now, let's take this out. Now, that is kind of using the example of a price action type trader, right? Now, we also had a different, we also explained another type of confirmation, so indicator, for instance. So an indicator-based trader will still look at the market the same way, right? The indicator trader will look at the market the same way that, you know, the other person looks at it. The only difference is how he will look to confirm his entry will be different. So let's say an indicator trader might be looking at price within this area, and maybe I don't really use indicators, right? But maybe I might look at, let's see, let me see if I can pull out MACD. So let me get an indicator here. Let's use RSI, right? So an indicator trader might maybe use the RSI, which is the relative strength index, and say, okay, if price comes back to this area and the market is within 60 to 100 or 70 to 100, I would look to, did I click on this? Okay, I have. Where is it? Where's my indicator? Okay, down here. Now, an indicator trader would say, okay, well, if price, let me take this back a little. Let's jump back here. Let's go back to the same area. So an indicator trader might look at this and say, well, market has broken lower, I'm looking to sell. What I want to see is, I want to see price. Oh, what is going on? I don't want the second one. Let's close this one. Okay. So if price comes up here, I want to see price maybe within the oversold or overbought region or something of the region, or let's say 70. So let me just put something here. If price gets up to like 60 or 70, I would use that as a reason to sell. That is consider it over. Now, you get the idea of what I'm trying to say, right? Now let's play price, and you know, the market goes up. Jackson, is he there yet? No, he's not there. Is it there yet? And does he get there? Now, in this particular example, well, price is not really touched it, right? But you get the whole idea. So he's waiting for the indicator to confirm his entry. And once the indicator does confirm his entry, that would serve as the reason for actually going to, looking to go long or short, right? So you get the idea. That's what an indicator, an indicator-based system in this instance might also be looking to use. Now, again, what is the next one? So counter trend line break, a counter trend line break in this instance. So let's look at this area, for instance, right? So I'm going to, okay, I can't do replay on lower time frame on this particular login. I'm not logging into my page version. Okay. Anyway, nonetheless, now the counter trend line trade or counter trend line break is a situation where you're looking at the market, right? So let's look at this region. Highs to low, to lower high, to lower low, and now a lower high, right? Now, so all as price is going up, right? Somebody who is looking for a counter trend line break. Let me make this. We'll look, let's say, on a smaller time frame. Now, on a 1 hour chart, right? On a 1 hour chart, this move here will look something like this, right? Now, a counter trend line break would be, you might now maybe find a trend line that you can now be watching for. And then when market breaks below it, that could serve as confirmation. You could look to sell the retest and then take that lower, right? So in this instance, you could have a trend line like so, where if price breaks below the trend line, you go back on the retest of that, you sell, and then you use that as confirmation to get involved in the short position. Okay, let me go down to let me end this. Let's look at let's go back to that area here, which is here. Let's look at the 1 hour charts. Let's see if we can spot that region. Zoom in, zoom in. I hope the bar would go back that much. Okay. Let's see. Okay, let me use the 4 hour charts because the 1 hour chart doesn't go back that much. Okay, so this is the 4 hour chart. So that right. So this is a 4 hour chart to that area. We could have a trend line like so, right? And you can see what happened here, right? So the market started pulling back up. We had a trend line and at an angle where the market respected it. And what do? We broke the trend line. That serves as confirmation. And then a counter trend line trader will use maybe the close of the trend line or the test of the trend line as a reason to get involved selling. Put your stop loss just above there and you go after the low. You could see that everybody has the same idea to sell, looking to sell from a particular area, but you can confirm your entry based on what is most comfortable by you, right? And that's, that's his own style. That's this person or this trader's own system, and they make their money and, well, everybody's happy, everybody wins, right? Then the last, or the not the least set of type of confirmation would be somebody who is looking for structural shifts. Now, structural shift is one where, well, if a market is bearish, you expect it to be making lower lows and lower highs. If it begins to make higher lows and higher highs, it means it has shifted structure, right? It means it has shifted structure. And so that could be your reason for looking to buy and continue going up. In this case, what would that mean? It will look like this. You can see that as price begins to move up, it started to make an uptrend. And then what you're watching for, because remember, on the longer term basis, you're looking to sell. So you want to see the shift that will, from the bullishness to the bearishness. And then you can see this is still high, low to high, higher low, higher high, higher low, higher high. What next? You now see what happened. Now, ideally, price will continue to make another higher low and higher high. But then price made a lower low. You can see that. And this is the shift that you can then be looking for to get involved in a sell to then take all this down. So you see the same idea in terms of looking to trade, but then because of confirming our trades, we can now decide how to enter, right? Now, another system, in terms of indicator could be Fibonacci, right? So somebody could say, once the market, once price makes a structure and it has shown bearishness or bullishness, I'll look to get involved buying or selling, right? Now, let's go back to this daily chart here. And somebody would say, so let me get back here. So let me just clear out this. So somebody could look at this and say, well, this is the high, right? And this is the low that it formed, right? And then all you look to do is trade the 61.8 fib retracement. So you just draw your Fibonacci and you look to sell from around that region. So if price gets to the 61.8, and then there are certain types of trade setups that look like this. So you're looking to sell from within, let's say, the 61.8 or the 50.0 or the 78.6. If price now gets into that region, you now start to look for confirmation before you enter. Right now, some other people, once they see, because Fibonacci or something like that, they'll just set a pending order, right? And put stop loss, put take profits, and it's all good and fine when it goes your way, when the market is still continuing to trend. So let's take this example here. This is our high, right? This is our low. Let's say you're looking to sell the 61.8 and you want to put your stop loss just above the high. So let's say 78.6 in distance. And you put your stop loss just above the high and you're targeting this low, right? Well, you make profit, right? Price comes in, you make profit, you're happy. and you're smiling. Now, when you don't confirm your entry, it will look something like this. Remember, the market is still bearish, right? It's still bearish. Why? Because it's making lower lows and lower highs and lower lows and lower highs and, basically lower lows and lower highs and lower lows. So somebody will do the same thing. Oh, I'll draw my Fibonacci from here to here, right? And then I'm just going to sell the 78.6, right? Sell the 78.6, stop loss below here, and I'll target stop loss above here, and I'll target this low. Well, even in this instance, you could have even made some profits because price bounced away. That's if you manage your position. But because if you don't confirm your trade, those times where, especially for those who look at areas like support and resistance, and they say, oh, this is a strong level of support or a strong level of resistance, or, this is a strong level of resistance, strong level of support. And then if price gets up to resistance, they automatically start buying, right? Sorry, or start selling, hoping that price will come down. If price comes down to support, they start buying. They try to buy resistance, buy support, sell resistance. And then you notice those times where price will just get to support, do something like this, and continue to go down. And then people who did not wait for confirmation will find themselves sitting at the wrong end of the trade because price did not confirm that it wants to respect that area. And then it got involved prematurely and have to take a huge loss. Okay, so that's the essence of confirming or looking for entries or looking to confirm your entries, because it will help you to avoid bad trade setups, and it also enable you to maximize your profits while also looking to minimize your risk. Okay, so now we've spoken about a lot in this during this session, from what should be included in your trading plans, what you want to have included. So in terms of how you confirm your entries, how you identify areas you're interested in, and then some examples as to how you confirm your entries, from price action to indicators to confirmation to counter trend line breaks. All these important points are there to enable you. I hope you enjoyed the class, and this is where we will now take your questions and